वेलकम टू वीलर्न। वीलर्न में आपका स्वागत है। Topic for today's discussion is mergers and acquisition. We are covering session 13, that is identifying acquisition opportunities. Topics which we would be covering are introduction, approaches for selection criteria, fixing up prices for acquisition through acquisition for cash and acquisition for stock, and fair value institutional criteria. In this unit, we will learn about various acquisition opportunities. We would also be able to understand the different selection approaches and the price fixing for acquisition. We would also discuss that a takeover basically generally involves acquisition of certain block of equity capital of company, which enables the acquirer to exercise control over the affairs of the company. But in theory, the acquirer, it must buy more than 50% of the paid up capital or paid up equity of the acquired company to enjoy complete control. However, in practice, the effective control can also be exercised with a smaller holding also. So it usually ranges between 20 to 40% because the remaining shareholders, because they are so scattered and they are so ill organized, they are likely to challenge the control of the acquirer. When we discuss about the approaches of selection criteria, so the basic purpose of validation of target company is to locate the possibilities of takeover. So valuation techniques, they serve the purpose of identification of target companies for takeover, as well as it serves the basic purpose of fixing the exchange ratio in case the target company is finally selected for acquisition. Some financial experts, they have suggested two approaches. One approach is present value analysis and the second is capital asset pricing. When we say present value analysis, so it is basically related as valuation which is based on net earning basis for any listed company, and it is the same as used for dividend analysis. In other words, when we discuss the earning or the target firm, they are projected and discounted at the acquirer's cost of capital to obtain a theoretical market price on the shares of the target company. This is then compared with the actual market price to determine the net present value on investment. When we say capital asset pricing and we compare it with this present value analysis, so present value approach, it does not consider the risk posture of acquisition, that is portfolio effect. So the capital asset pricing, here it consider that aspect also, the portfolio effect, the risk effect. So theoretically, when we say asset value or present value analysis, it is a superior theoretical framework and is very helpful in merger partners, the target company. But the logic behind this very model is that if the expected rate of return, it exceeds the required rate of return, that is ER, then the acquirer company, it has the green signal for obtaining or acquiring the target company, and equation wise it is described as which is shown in the screen. So when we say the prices, the equation it states that ERJ is equals to RF plus ERM minus RF BJ, where ERJ is represented by expected and or required return. ERM is the expected return for market index. RF is the risk-free return. BJ is beta, normally determines the past performance, and J becomes the potential merger partner, that is the target company. Now, fixing for acquisitions when we say, so in any takeover, valuation of shares of a company, it is dependent to a great extent on many factors to price fixation of shares. So when we say these share exchange ratio is generally determined by first the market price of share. When we say the market price of share, here if the offeree and the offerer, they are both listed companies, the stock exchange prices of the shares of both the companies should be taken into consideration, which existed before commencement of negotiation or announcement of the takeover bid, to avoid distortion of in the market price which are likely to be created by interested parties in pushing up the price of the shares of the offerer to get better deal or vice versa. The second is dividend payout ratio, DPR. Here the dividend which is paid in immediate past by the two company becomes very important, as the shareholders, they want continuity of dividend income. In this case, what happens, the offeree company was not paying dividend or its DPR was very low than the offerers, then its shareholders would opt for share exchange for the growth company by sacrificing their current dividend income for prospect of future growth in income and capital appreciation. When we talk about price earning ratio, that is PER, so price earning ratio of both the offerer and offeree companies, they are compared to fudge relative growth prospects. Companies with lower PER, it shows a record of low growth in earning per share, which depresses market price of shares in comparison to high growth potential company. Furthermore, growth rate of combined companies should also be calculated. When we say debt equity ratio, in debt equity ratio, company with low gearing offers positive factor to investors for security and stability rather than growth potential with a geared economy having capacity to expand equity base. When we say net asset value, NAV, so NAV of two companies be compared as the companies with lower net asset value, they have greater chances of being pushed into liquidity. So the final exchange ratio, it also can be dependent upon many factors representing the strength and weaknesses of the firms in the light of merger objectives, which may include liquidity, strategic asset management capabilities, tax loss carryovers or reproduction cost. It may also even include investment values or market values, which is combined companies shares or the book values. So in any share exchange consideration for mergers, the shareholder of the offeree company becomes the shareholder in the combined enterprises. Share exchange ratio is generally determined by relative bargaining strength of the two companies. Two companies, when we say the weaker company's earning capacity or financial strength, it renders it weaker in bargaining strength, and thus its shareholders are likely to have low value for the shares worth. When we talk about the feasibility analysis or for cash acquisition, so feasibility assessment की जब हम बात करते हैं कैश पेमेंट्स कोई भी टेक ओवर या मर्जर सिचुएशन में, इट हैज़ टू टेक इनटू अकाउंट 3 फैक्टर्स. पहला फैक्टर जो है, द फर्स्ट फैक्टर दैट is very important is the quantum of cash required to acquire. कितना कैश की क्वांटिटी हमें रिक्वायर है, what is the total amount of cash which is required to acquire the firm. दूसरा होता है कि एक्वायरर कंपनी जो है, जो फर्म एक्वायर करने जा रही है, उसकी लिक्विडिटी पोजीशन कितनी है, हाउ लिक्विड दैट फर्म इज इन इट्स फाइनेंशियल्स. लास्टली जो हम बात करते हैं वो हम बात करते हैं डेट इक्विटी रेशो की, कि एक पर्टिकुलर फर्म की या फिर जो टारगेट कंपनी है उसकी डेट इक्विटी पोजीशन क्या है, क्या उसके पास डेट्स हैं और क्या उसके पास इक्विटी की पोजीशन है. So in any kind of cash transaction, the acquirer company's shareholders equity, it remains the same. It does not change at all. So the quantum of cash for acquiring the target company is assessed keeping in mind the liquidity of the combined company, that is post acquisition. So it takes into account the debt capacity post merger, less total debts of the two companies plus total marketable securities of two companies, that is pre-merger we are talking about. So post-merger debt capacity is assessed by multiplying acquirer's equity by targeted debt equity ratio. First we have discussed acquisition of cash for feasibility analysis. The second situation comes as acquisition for stock. So when acquisition for stock is done, what is the feasibility analysis in that scenario? So when it is done on the basis of share for share, when there is no cash transaction, so when the acquirer company exchanges shares for shares with the target company, there are certain steps which are to be taken care of. So the first step is the acquirer company's shares are valued, it is estimated. The second is computation of maximum number of shares which the acquirer company can exchange with the target company. So there are different scenarios and at minimum acceptable rate of interest which is being taken care of. The third is to evaluate the impact of acquisition on earning per share and the capital structure. So what basically is the impact on the share or the capital structure when the acquisition is done. We can also say that whenever and where market quotation is lower, as in it indicates that the market has undervalued the acquirer's shares. So different alternatives are available, that is acquirer can give total value in cash or partly in cash or partly in equity, depending on how to maintain its own shareholders in a better off position. When we talk about fair value or the institutional criteria, so what are the basis for arriving at fair value? What is that fair value and how do we arrive at that fair value? So all India level, there are financial institutions and banks. So they follow two criteria basically. Past records of the company, and the elements to be considered in arriving at fair price. So past records of the company, here the fair price is worked out on the basis of past data of the company. The second is the elements which are to be considered in arriving at the fair price. So what are the elements which a company or these financial institutions or banks they consider for arriving at a fair value figure? So the first is the breakup value per share. The second is the national book value or the notional value which is based on the earning and yield expectation, and lastly the market value per share. When we talk about the breakup value, it is arrived at by having taken care of both the assets and liabilities which are to be deducted. When we talk about assets, so the value of assets which are disclosed by the balance sheet and not the replacement value are to be taken into account. Even if there are adjustments which are arising from the revaluation of assets, they are to be made very clearly. Second is areas of depreciations, they are to be taken into account. Third is bad and doubtful debts, they are not provided for to be deducted. The fourth is intangible assets, they are to be excluded. But however, care should be taken to avoid double deduction in case any of the intangible assets were accounted for under item B, that areas of depreciations or capital reserve on revaluation. Right. When we talk about the liabilities which are to be deducted, these are preference share capital or outside liabilities, whether by way of loan or debentures, deposits or sundry creditors. There could be provisions for gratuities or taxes, dividends payable out of reserves and surpluses. Unclaimed dividend is one of the other liabilities. Another is arrears of preference dividend. And lastly, contingent liabilities. And if not extinguished and any adjustments arising from notes given in the balance sheet, these should be taken into account. So the net asset value is divided by the number of equity share to arrive at the breakup value per equity share. When we talk about earning capacity value, so the first one is average earnings. So these average earnings, they are basically the past 3-year average of profit after taxes less preference dividend is taken out, the fluctuations in trade and industry. Sizable extraneous incomes or gains for sale of assets, so net of tax wherever it is applicable, are also excluded here in this case. Furthermore, appropriations towards development rebate or similar reserves is not deducted. Average of profits or estimated profit after taxes for past 3 years, they are generally taken care of. Another is yield rate and capitalization of earning. So here the expectation of yield would vary from time to time. From the institutional point of view, the rate of return on long-term loans or dividend rate on preference share capital, interest rate paid by companies on term deposits from public would be the major indicators. Furthermore, the yield on equity share, it has to be higher. There are market expectations regarding dividend and capital appreciations, which are very important factors in determining the share price. At the same time, there are speculative pressures or market rumors dealing on behalf of parties interested in acquiring control, and the prospects of sanction of financial assistance by the institutions, which have a bearing on the market price. So the average market price of the share, high or low, for the past 3 years is to be taken into account. So to arrive at the fair value of share on an average, first the breakup value is considered, second the earning capacity value, and the third the average of market prices, whether high or low, for the last 3 years can be worked out. However, the latest market quotation, which is below the price worked out, it would be worthwhile giving due weightage. Right? There are 2 exercises. What are the various approaches for selection criteria, and what is the feasibility analysis for cash acquisition? Thank you and have a nice day. Keep learning and relearning.